It happened again.
Hello and you got lost in the dance again. One more time, you got lost in the dance. Every time. Hello and welcome. You're joining us live for the Investor Lab, the epicenter for passionate people seeking a life of freedom, choice, and abundance. Just before we went live, Gabby was talking to me about how she gets lost in the sauce and how she really needed to focus on making sure she faded out the track on time, and then literally seconds later, lost in the dance. So, Gabby, how are you today?
I'm good, man. How are you?
Good, but I'm not quite sure how I feel about getting manned. Good man. How you, bro?
Sorry. Bro, dude. Oh,
I'm not quite sure I'm ready to be your bro or your dude, bro.
Dude, you know my dude.
Hey, Jared. Hey, Matthew.
Yeah.
Great to see you guys in the chat.
Hey,
if you're
folks.
here live, let us know because it's great to
Let
see
us
you. We'd love to see you here
know.
live. We had some great interaction with everyone last week. We're looking forward to having more again this week. Gabby, you look like you got something to say.
I do. I just wanted to say, because you asked me like how I am, and I said, good man, which we can debate if that's what I should be calling you that. But anyway, I was actually thinking, I was reflecting on the week because I am actually pretty good right now. I feel like we've had a good week. I feel like I'm working on some really cool things in the business, but adding a lot of value, hearing a lot of cool stories too, because we're doing a lot more like end-to-end portfolio work with our clients. And so hearing backstories from our clients, talking about the results that we're helping them to get. So like one comes to mind the other day where we actually helped a client to signed in maybe 2020. We started working with them. My internet.
I'm not sure if that's your internet or if what's going on there, Gabby. You just had a little glitch out there. Let's check.
Just see my big eyes frozen open. Anyway, if you can still hear me. So we had a client that we signed up, I think in 2020, and we actually just helped them work through the process of selling a property, and they've made really awesome returns in selling that. And they're just sharing how like life-changing that's been for their family. They've got a young family. Partner's pregnant with another child. Like, it's a really cool story. And it was just like, I love hearing those every week because it's kind of like wrapping up the end to end of why we're doing any of this. Like, we want to hear that what we're doing is having an impact. So I'm feeling good.
Yeah, that's awesome. That's awesome. Yeah, I mean, it's pretty impactful when someone starts investing with a very small amount of money, and then just a few years later, they end up with, several $100,000 landing in their bank account. It's pretty transformative. It's life-changing stuff, So, but that's good. I'm glad you're feeling good. Do you want to just double check you're connected to the right internet, just to make sure that we've got the right connectivity? Because you seem to be glitching a little bit. I'm good. I've got like 414 and 296, so we are good. Whilst you are doing that, let me set the stage for what we're going to be talking about today, because I'm actually really, really excited for this topic today, because we're going to be talking about, are we entering into a property market super cycle, which I think is a really, really interesting topic. I've got some very strong opinions on this. And I think that it's a really relevant conversation to be having in the market today, because I think a lot of things are changing. And I would love to know, if you're joining us live, let us know in the chat, do you think that we are entering into a property market super cycle? I'd love to hear from you guys. I'd love to know what you think. Gabby, how's your internet connection going?
It is the slowest I have seen in Thailand, which is still 150 meg, which is still fast for Australian standards, but it is slow for me. So that's what's going on.
Okay, cool. Well, let's persist anyway. Let's see how we go, because I think it seems to be jumping a little bit, but might just be the weather. So let's crack on. So you were very interested in this topic too, Gabby. So where do you want to start with this?
It's funny. I hear the title, right? And I hear, oh, this is interesting. Like, talk about market analysis and what's potentially coming. But I always think that our best conversations come when I just ask you the questions that come to mind. And I do my best to think through, like, what do I think people are asking about this particular topic? So I just want to start with, what the hell is a super cycle?
Yeah, so I'm just going to address Neutral Rockets just in the chat there said, this isn't some 18-year thing, is it? which is hilarious, because Gabby and I were just actually talking about this before we got on, before we went live, about the 18.6-year cycle. And no, this is not talking about the 18.6-year cycle, although we can if you want, and I can tell you why I don't think it is true and going to hold true. But what is a super cycle? So a super cycle by definition, is a multi-year structurally driven upswing in prices fueled by macro forces, supply and demand imbalances, and demographic trends. It is marked by fundamental shifts that drive persistent demand, investment, and price increases. So that is what we mean by a super cycle. So as opposed to a boom, which is like what we might call like the kind of post-COVID boom, when a lot of liquidity was pumped into the market very fast, and we kind of had there was something like over 90%, I can't remember the exact number, 93% of suburbs in Australia all went up at the same time, and it was quite short. Like it was sort of like a 12 to 18 months real kind of boom before that kind of started to soften out. That is a short, sharp, sporadic burst. A super cycle is a structural shift. So structural shifts include the internet was a structural shift. The mobile wave was a structural shift. So if you think about Facebook, for example, when it made a big shift, and it happens to be a friend of mine because I was talking to someone about this yesterday, when they made a big shift to focus on mobile, that was because they could see that there was a big structural trend changing that was going to drive growth in a particular sector. So you can think about these things as being trend-based and structurally driven. And it doesn't mean that things go straight up and to the right for a very long time. Like there's still going to be natural volatility and natural kind of fluctuations along the way. But typically it is an above median, protracted long-term trend over several years. So sometimes even several decades is a super cycle. Does that kind of make it a little bit clearer?
Yeah, it does. It helps to, I guess, differentiate between just like what's a normal boom. And I think particularly like in reference to like the COVID boom, how do we know that what people are talking about right now is a potential sustained cycle versus just a boom?
Well, I don't know. I'd have to take a little step back from that, Gabby, because I don't know what people are talking about. I don't know what that point of reference is. I don't know if anyone else is talking about a super cycle, but I can tell you why I think that there is a super cycle. So I think defining a super cycle and actually then understanding why I think there's going to be a super cycle, which can easily be debated, I think is useful. I'm not actually sure what other people are saying about the market. I'm not really sure, so I can't comment on that specifically. What I can say though is that I think like there's a couple of key things that we need to identify in there. And one of those is that that super cycles are marked by fundamental shifts that drive persistent demand, investment, and price increases. I think that needs to be the frame of reference. So how would we know if this is like a normal real estate market cycle, or how would we know if we are entering into a super cycle? I think that's some pretty significant distinctions, because real estate markets tend to ebb and flow. They always have ebbed and flowed with a general upward trending bias. So how would this be different from something that is just like part of the normal course of business? Like, and there are business cycles, real estate cycles, all of this kind of stuff. Now, if we take a little step back, I think fundamentally most of these kind of cycles or cycle theory broke down in about 2008 in the GFC, or 2008 to 2011 during the GFC. And the reason I say that specifically is because that's when we had kind of the great reset in terms of interest rates globally. So for 50, 60, 70 years or whatever it was before that point, we had trackable, traceable cycles. And if anyone's familiar with the 18.6 year cycle, it's based on those trends. It's based on trends that perpetuated from a pre-GFC environment where there were different credit cycles rolling around the world, which caused different kind of periodic fluctuations that you could kind of track more consistently. But then what happened in 2008 is the world kind of reset against itself. So basically during the GFC, all the governments around the world dropped their interest rates down to zero, basically refinanced all their debt, and kind of synced up the global debt refinancing cycle into one. And so then you had that kind of tracking forward, and then that happened again in 2020 thanks to COVID. So we had those kind of things kind of play out, and those kind of things have reset and changed the dynamics. So I think that that's one thing that has kind of shifted the general cycle theory, and also one of the main reasons why I don't think that the 18.6 year cycle holds true. Now, if we then take a step back from that and say, okay, is it still reasonable that there would be some natural cyclicality in markets? Yes, I think it would be reasonable to say in in a static environment, not influenced by the things I'm going to talk about in the moment, would it be reasonable to expect that we would have a like normal cyclical behavior in markets, ebbs and flows? Yes, I think that is normal. And the reason I would say that is normal is because that is normal in almost every natural system. So in every natural system, you see that things kind of grow and contract, and it's kind of like thinking about the yin and the yang. In the yin and the yang is the harmony of masculine and feminine. But also the thing about the yin and the yang is it's never going to be perfectly in balance. What it is going to always do, and anyone who tries to find balance in any area of your life, you're going to realize that perfect balance is almost impossible to maintain. So you're actually going to be oscillating between slightly too much and slightly too little of any of the things that you care about at any given point in time. And that's the same of all natural systems. It's the same with tides. It's the same with ant colonies. It's the same with kangaroo mobs as well. So kangaroo mobs, when there's an abundance of food and water, their sizes just exponentially explode. Take away the food and water, and they contract. And so and they exponentially explode. They have more kangaroos that eat more food and drink more water. They run out of food. They run out of water. They stop breeding. Their population collapses, and that's a natural kind of ebb and flow. So given the fact that you could relate that to kind of natural market states, then you would reasonably say that market cycles would continue as per normal to fluctuate and oscillate. Another way to think about this in a real estate context is, to oversimplify suburb market dynamics, you could simplify it down to jobs, lifestyle, and affordability as the kind of three fundamental drivers. Now, the affordability piece is really, really interesting because that's relative local affordability. Now, relative local affordability, if you just think about that in context, that can also oscillate too. So you may have a suburb that in 2019 the median house price was $200,000, and that may have been cheap in relative terms to the local wages. Then maybe that market blew up to 450,000. It went from 200,000 to 450,000 median house price. Then that became, in local terms, slightly more expensive, right? And so maybe market demand cooled. But then if the median house price is still 450 grand in that suburb now, it's probably cheap in relative local affordability terms. And so these things naturally kind of cause market dynamics to kind of breathe in and out. And that's where you get the natural cycles. Now, what I want to speak to is why I think that there is a structural shift, a fundamental change that is actually going to drive a longer term cyclical uptrend that we would consider to be a super cycle over and above what we would normally think of normal real estate cycles. And there's a few kind of key things to my thesis, and then we can kind of break them down and we can kind of get stuck into it. But do you want me to just kind of go through what I think they are?
Yeah, for sure. Go for it. Yep.
Perfect. So the number one thing is systematic monetary debasement. Now, we've spoken about this before, so you can check out previous episodes. So I'm not going to go into the whole kind of background of like what monetary debasement is, why it's happening, but it is the devaluation of our currency over time. The average devaluation rate of the Australian dollar over the last 65 years is about 10 to 11%, depending on how you measure it. So that basically means that every single year you're losing 10 to 11% of your purchasing power over time. That is why things get more expensive. So that's the simplest way that I can put it. Now, the thing about that is that monetary inflation is essential in a debt-based monetary system. Because they need the money to supply to expand, because the government holds lots of debt, and the public hold lots of debt. Public holds lots of debt, and if unless we have monetary inflation, then the debt in the future is worth more than the debt today, because you're going to pay it back in future dollars that are going to be worth more than today's dollars. But in a monetary inflation environment, you're actually going to be paying back debt in future dollars that are going to be worth less because of the devaluation of the currency. I know that might sound complicated, but sit with that for a second. I'm not going to burn too many calories here, because the main point of why I think that this is a structural issue is actually based around AI. So AI is creating the single largest deflationary trend in our species, larger than any other macroeconomic or systematic change, bigger than the Industrial Revolution, bigger than the invention of electricity. Like, this is going to be the single biggest, most transformative event in the history of our species. And the challenge with that is it's going to create massive productivity gains, but that productivity is not going to be linked to labor. And we'll do a whole nother episode specifically talking about AI. So I'm not going to like go into that too deeply, because I think it's an episode in and of itself. But basically what that means is we're going to start to see prices being forced to the marginal cost of production. We're going to see significant deflation pulling through everywhere as costs collapse because of all of the advances in productivity that are not linked to labor. Now, the thing to understand about that is the greater the level of deflationary force from AI and technology, the greater the amount of money the government needs to print, because if they don't, then they'll be in a deflationary cycle, which means that that today's dollars will be worth more in the future than they are today, which means tomorrow's debt or the debt they have in the future is going to be worth more than it is today, and they'll never be able to pay it back. And Japan is actually one of the best examples of this. So they've had tremendous systematic deflation for, I'd have to look up the numbers, but like decades. And they have had the most amount of money printing ever, and they just can't get they can't get the economy to grow. They can't get inflation to happen, and so you get these structural forces which cause monetary debasement. Now, monetary debasement and the devaluation of the currency basically means that in optical terms or nominal terms, property prices will go up because based on the quantity theory of money, if you take all of the Australian dollars currently in circulation, real and in bank accounts and whatever, and you divide them by the sum total of all of the assets, goods, and services in Australia, you would get a nominal value of the currency. You would say the total value of all of the assets, goods, and services in Australia divided by the amount of dollars that we have circulating in the system gives the dollar the value. If you double the amount of dollars in the system and you have the same amount of goods, services, and assets, dividing those two together is going to mean that it will take you twice as many dollars to buy the same amount of things, because you're just going to double the amount of dollars, but you're not going to double the amount of things.
Mm-hmm.
This is why house prices continue to trend upwards, even when wages are broadly stagnating in real terms over the long term, all this kind of stuff. So because I believe that we have a systematic deflationary event that is already happening, that is already taking hold, we've got companies like, and we'll talk about this more again in another episode, but we've got companies like Microsoft and Amazon that are gutting their workforce and replacing people with AI. We've got Klarna, who reduced 40%, Klarna, multi-billion-dollar fintech company that replaced 40% of its workers with AI. Like, this is happening now. So that's going to drive prices. That's going to drive prices down, and governments are going to need to print in order to kind of keep prices up so that they can kind of keep things inflated in nominal terms. That means that money is going to flow to safe haven assets like real estate. And that is, so two things are going to happen is demand is going to increase for real assets like real estate. And also in nominal optical terms, asset prices are going to increase because you're going to have more dollars in the system and, a similar amount of assets. Does that make sense so far?
Yep.
Okay, perfect. So that's number one. That's just number one. That's kind of like the other really big thing is an extreme housing supply demand imbalance. So I haven't checked it. I haven't checked it in the last couple of months, but I looked at it last year, and between 2014 and 2024, we had a compound annual growth rate of negative 2.2% in building approvals. So that basically means every single year there was 2.2% less buildings getting approved than the previous year, which is crazy. So that's a declining trend. So it's a negative compound growth rate of building approvals. So less and less and less. Not even just like the same amount and we're getting more people. Actually, systematically less buildings getting approved every year. At the same time, we've had record migration, a record population growth driven by systemic migration. Now, again, I'm pro diversity. I'm pro all this kind of stuff. So don't take any comments I have around immigration as being kind of, nationalist or whatever in any way, shape, or form. I'm a big believer in the freedom of movement. But the reality is, with that many people coming into the country, without an increase in housing supply, you're going to end up with a housing supply deficit. Like it's real. And in fact, I'm just looking for some numbers here at the moment, but I think that I'd have to double check, and I don't want to get distracted. But I think that we are currently running at about a deficit of around 52,000 houses per year. I think we need something. Don't quote me on this exactly. I can get the exact numbers, but I think it's something like we're building something like 228,000 houses a year, and we're building something like 172,000 houses a year, and we need 228,000 houses. It's something like that. So, that is a huge deficit. Now, just to put that in context, and again, we can dig into some of these points. Maybe we can dig into each of these points one by one, actually. But so maybe I'll slow down a little bit, and we can go through them all. Otherwise, I'll just be talking all day. But just to give a little bit of context around that figure that I just mentioned, the 52,000 houses. Because people go, okay, 52,000 houses, or they hear about these like massive deficits in housing supply. Just to give you a little context, the largest hotel in the world, called the First World Hotel in Malaysia, has 7,351 rooms. 7,351 rooms. We're talking about a deficit of 56,000 houses a year, right? The largest hotel in the world has 7,351 rooms. So like, I'm not going to do the maths, but several orders of magnitude less. That can house 15,000 people. So basically two people to a room. And in Australia, the current housing occupation rate is 2.26, I think it is, which basically means there's 2.26 people per household. So actually not that dissimilar from a hotel, really, right? So, but let's use, so it's basically, so that'll house 15,000 people. Do you want to know, Gabby, take a guess. How long has it taken how long did it take to build that hotel? Do you want to guess?
3 years.
No, it took 13 years. It took 13 years to build the first word hotel, and that was to build 7,351 rooms. And I'm just looking up something else here because this is really interesting as well. So the Burj Khalifa, which is a lot more commonly known to people, that can house 10,000 people. So that would be the equivalent of, say, let's say 5,000 houses at 2 people to a house, something like that. That took, and this is Saudi Arabia throwing Saudi Arabia or UAE throwing everything they could at it. That took 6 years, and that's only the equivalent of 5,000 houses. So the point here is that we have a deficit that I don't think people are truly comprehending. Everyone's saying, oh, yeah, there's not enough houses being provided. We've got too many people, all that kind of stuff. But no one's actually contextualizing what does this actually mean, right? And if we're falling short by 56,000 houses or properties or apartments, whatever you want to call it, I don't really care. We can get into semantics. 56,000 properties a year, we're short. That would mean that it would take us decades. It would be probably the largest single civil engineering project on the planet to build enough houses to catch up. And it would take decades. Like there is no chance that and that is just thinking about 1 year's worth of undersupply. That's 1 year's worth of undersupply is 56,000 properties. How long would it take to build 56,000 properties? It would be, it's what
a long time.
56,000 divided by 7,300. That's 7.67 times larger than the world's largest hotel, which took 13 years to build. So the scale of the problem is not actually being rendered in people's minds. It is insane. And now we can go into some other things. There's go on.
That's factoring the current levels of immigration, right, into Australia. So that
correct, yeah.
In terms of the equation of like amount of houses we need, amount that we're supplying, the top level of that would be in the government's control in terms of like immigration volume, right?
Yes, but we already have a deficit. Yeah, so like we would still have to play catch up. I don't have the total deficit at the moment, but I think it's in the it's several 100,000 properties. I'd have to get the exact number, but it's several 100,000 properties. I think it's somewhere between 350 and 400,000 properties that we're short nationwide.
Yeah.
Right. Already. So even if we stopped migration or we got to like migration neutral balance, and we said, okay, let's just play catch up. Let's just be conservative and say it's 300,000 houses. Right. So if we said it took the Malaysians 13 years to build 7,300 connected properties in a hotel, which is a lot easier than building properties all over the country. That is 561 a year. Now that was one project, but like there's a builder shortage, there's supply shortages, the actual scale of trying to build 300,000 properties and that is assuming that we end up with a net supply balance or a net population balance where we don't keep increasing the population either through birth rates or immigration. It's it would literally take decades for us to solve this problem. This problem, that's predicated on the idea that someone's got an idea that's going to work that they're going to start today. Like that's pretty crazy. That's pretty crazy. And so, like, I have 6 other points of why I think we're entering into a property market super cycle. But I think those two, if you simmer it down to those two, AI is driving the biggest deflationary boom in our species. That is going to force monetary inflation. Monetary inflation is going to mean that property prices go up, and we have a decades-long deficit that we need to make up in housing supply, which is not going to be made up anytime soon. And it'll be by my reckoning the single largest civil engineering project, at least in modern times. Maybe not bigger than the pyramids. I don't know, but it'd be the single largest civil engineering project in that I could be wrong, but I can't think of a single project that would beat it in terms of scale. and that assumes that someone has a plan, which no one does, right? So if you just took those two things together, those two things are pretty powerful. And I'll actually shut up in a second, Gab, because I want to get your opinion on this. But there's a second piece to this as well, which is just if we just go back to the AI thing, and if we basically said AI is going to take everyone's jobs, and that's going to cause deflation, and that's going to cause monetary inflation, then you could reasonably assume, like, okay, so what is that going to mean? Is that going to mean that macro, there's going to be less demand for houses? What if there's population decline? What if there's, like, go a couple of decades into the future? What does that mean? My belief is that Australia versus other countries globally will still be a high demand location because of its prosperity, its quality of life, its quality of environment. It's got good rule of law, it's got good civil liberties, it's got good resources, good infrastructure, all of that kind of stuff. And so this phenomenon is not going to happen to Australia. It's going to happen to the entire world. And so what you would find is that demand would continue to flow into Australia from other parts of the world. So if you think that Australia is going to be negatively impacted, think about all of the countries in Africa, think about all the countries in Asia, think about all the countries in Central Europe, think about all of the countries in all of these in South America, where they're also going to be experiencing the ravages of deflation, and they're going to be seeking a better life. And so what you're going to have is you're going to have global demand that's going to pull people into Australia, even when the ravages of deflation take hold. So I think that's going to create systemic long-term demand as well. So we're not going to have a demand deficit, although I think other countries will suffer and struggle during this period as they start to lose opportunities in their countries and they start to look for better opportunities abroad. So if I could simmer it down to two core things, it would be that. And then we can get into some of the other points as well. But what do you think so far?
Yeah, I think it's interesting, like you say, about money. Like, money flows where it's safest, and I think it's the same for humans, right? We will get to a point where we realize that, for now, I'm not going to go down that conspiracy path, but having options and being able to move freely through to countries of your choice. And a lot of people still will choose Australia for all the reasons that you mentioned, but it's like, I see the parallel there with what you're saying about money. In terms of the market cycles, I just want to summarize, and hopefully you can clarify if this is on the same track. So generally speaking, 18.6 year cycle. We won't go too far into this. If you're not familiar with the 18.6 year cycle, do a bit of research on it. We did actually, Goosey interviewed Akhil Patel a few years ago. I can grab the episode for that and put it in the show
and to be clear, I was an advocate of the 18.6 year cycle for a long time. I've now changed my stance on that. So
usually, historically, 18.6 I can't say it. 18.6 year cycle has held true. Decades of data on this. It seems to be pointing in the right direction. However, what is happening now, in your opinion, is that with the introduction of AI, I will say, and the monetary impacts of that, and on the impacts on the economy, and in Australia, the supply shortage of housing, that has kicked us off of that cycle. Is that accurate?
Kinda. So there's kind of two parts to it. Number one, we did a study internally to try and prove the 18.6 year cycle, and we tracked it back over 40 years worth of data, and we could see no actual evidence that the cycle held true. So
I don't remember that. Anyway, cool.
Yeah, we did so we did an internal study on that. We didn't do much with it because we were just like, okay, well, we can't see any evidence that there is that, and all right, fair enough.
Yeah, we'll do our own thing.
So we didn't need to make a big deal out of it. We couldn't find it. It's not to say it doesn't exist. We just couldn't find it. So, I think it's an interesting idea, and I think that there's a lot of research to support it. But also, I think that it might be true, and it also might not be true. Is kind of the way that I would put that. Regardless, I think that cyclical behaviors in markets generally changed about 25 years ago, thanks to the GFC, which was then reinforced again in 2020. And now we're in a different cyclical regime. But then all of that has changed because we're at probably the largest evolutionary inflection point of our species with the introduction of AI, and that is changing the dynamic. Yeah.
Mm-hmm. Yep. Cool.
Sweet. Okay, so where do you want to go from here?
Where do I want to go from here? I'm just looking through my notes.
Because I've got like 6 more points on why I think this is going to play out the way that I think it's going to play out.
Yeah, I think if we I do want to make sure that it's actionable, and we can get to this later. So I think having more context from you on why, because maybe people are still doubtful because I think with AI in particular, it is such a unique experience, and we haven't experienced this before, so it's hard
Mhm.
to actually know the impact that that's going to have. And so we can theorize that, yeah, it's going to have this huge impact, but if we build out more of an argument to support, like,
No, no, I don't think it's theoretical that it will have an impact. It already is having an impact. I think that people aren't noticing it. It's
yeah,
already having
I
a
think,
deflationary impact.
yeah, for sure. No, I agree with you. I'm just saying, in this context of, is a super cycle coming?
Yes.
If we hear that AI is going to contribute to that, again, I agree with you, but a
Mm.
lot of people might not. It might not land a lot with people yet. So
Okay. So
just
so
hearing
so
about
let
the
me let
points
me
that you have.
Okay, cool. As I said, I've got a bunch of other points here. But like again, if I anchor it back down, hey Charlie, nice to see you there. If I anchor it back to the kind of two overarching premises, it is number one that we are going to experience a significant amount of deflation thanks to AI. So let's unpack that just for a second, so everyone can anchor that, because AI is not some cool chatbot. Like it's not just a chatbot, because a lot of people that aren't engaging with AI, they're going, "Oh, it's a chatbot, right?
Mhm.
Great. What is that going to do?" Fundamentally, jobs are being replaced because we have no more need for human labor thanks to the advent of AI. And that's happening already. There are entire factories in China which are now driven by AI and robotics. They call them dark factories because they don't even need lights anymore because all the machines just do the work. There are layoffs happening all around the world at major companies, which is decreasing the cost base of those companies and allowing them to drive prices down to stay competitive, which is actually what happens. So
Mm.
when companies strip out costs, they don't just sit there and get fat on the profits. They actually lower their costs to beat their competitors. What they want to try and do is provide more for less. And that is the free market dynamic. And that is why, and I borrow this from Jeff Booth, in a free market, all prices fall to the marginal cost of production. That is because for anyone to succeed in the market, in business, in providing value, they must continuously seek to provide more for less. That is the only way to really succeed long term in any specific environment. Now, sometimes more for less means keeping your prices the same whilst wages go up, and it's less in relative terms, and that's okay. So it's not always number go down, but it should be number go up. Should be number go up less quickly than wages, or it should be value goes up more than significantly more than wages, and price goes up less than the value goes up. So there's an equation there where it has to be more for less in relative terms. Now, AI is again transforming the entire concept of work. So
Mhm.
so companies and industries are now moving from, you know, sorry, let me rephrase this. So there was a big conference in Saudi Arabia just over the weekend, and Jensen Huang, the CEO of Nvidia, said that robotics is going to be a $50 trillion industry. Now, what's interesting about that? There's no $50 trillion industry on the planet today.
Mhm.
There is not a single industry that is $50 trillion. What he's actually talking about is the industry of labor. He's actually talking about labor
Mm.
as an industry. And so when you combine AI and robotics, what you have is you have labor of the mind and labor of the body. And those two things are getting completely replaced. With AI right now, in fact, one of our senior team members, I actually just paid for them to get access to an advanced version of an AI platform that I won't mention, but that's fine. He said in 40 minutes he had his mind blown, and now he can see everything I could see. He just completely had a meltdown because he could suddenly see the future of his own work. Now, I know for us at Dashdot, we're not seeking to replace our team, but we are seeking to grow without adding headcount. We're seeking to preserve the team that we've got, but scale up without continuously having to add more people. Not to say we won't hire any more people, but we want to scale in a non-linear fashion thanks to the advantages we can get through AI. That allows us to provide our services to clients at a lower price, or keep our prices stable, or do all this kind of stuff to try and compete and provide more value for less. Now, that is a fundamental driver of what's changing in the economy. Now, the thing about that is, if we can understand that that is true, and the AI is creating deflation and productivity advancements, and if the net result of that is the companies are going to lower their prices to stay competitive and to kind of beat other people in the market, because prices fall to the marginal cost of production, if we take that to be true, what that is going to mean is that prices are going to go down. And as prices go down, that creates a concept that we call deflation. Now, governments need inflation. They need the money. They need prices to continue to go up over time, because they need to be able to print more money. Because the Keynesian economic system that is currently the main model of economics, modern monetary theory that drives our current economic model, dictates that growth is driven by the expansion of the money supply. And if you want to be able to expand the money supply, you need prices to go up at the same time, right? And so, or those two things are related. If you have prices falling, then you need to print more money so that you can drive up the prices optically, so that it keeps the system in check. And because printing money devalues dollars, if you have a deflationary environment, what you would have is the value of your dollars becoming worth more in real terms, i.e. you'd be able to buy more stuff with the amount of dollars you have, which would mean that your debt in real terms would be worth more than it would be in an inflationary environment where you can buy less stuff with the dollars you've got. So that means that debt in the future is worth more than the debt today in an inflationary environment. In a deflationary environment, debt in the future is worth more than it is today. In an inflationary environment, debt in the future is worth less than it is today. That's why debt makes sense in an inflationary environment. In fact, when the inflation rate was higher than the interest rate, you had negative real rates, which meant that you could borrow money and actually be making a yield on it. When the inflation rate was higher than 6%, I think at one point it was maybe the inflation rate was 8% and the interest rates were 6%, you were making 2% just by holding the debt, just in very simplistic terms. So if we take that to be true, then we don't need to kind of believe much. We just need to believe that technology is going to improve and that's going to cause prices to go down and that's going to cause money printing to go up. And if that is true, that's going to devalue our currency and that's going to flow into property. And if we believe that that is a structural shift, i.e. AI is changing the world and it's going to continue to change the world over the next decade, 2 decades, just in the same way that the internet did, just in the same way that mobile phones did, just in the same way that electricity did, all of this kind of stuff. If we can believe that AI is one of those mega trends and that the impact of AI is that it's going to force money printing, then we don't have to believe a lot to understand why that's going to cause money to be printed. The outcome of money being printed in Australia is that most of it flows into real estate. Most of it flows into real assets. And that's, again, based on the quantity theory of money, that the idea is that the value of the currency is the sum total of all of the goods, assets, and services in a country divided by the total amount of currency in circulation. That gives you the value of the currency. If you double the amount of currency, then it requires 2 times as much currency to buy anything. Now, that's a very simplistic way of looking at it, and different demand dynamics dictate that some things go up more than others. It's not like everything just goes up in the same way, but it depends on where the demand goes. And that's why property prices have actually outstripped monetary debasement in many cases over the years as well, because more demand goes there. So that's the first piece. So I don't think we need to. Does that kind of make sense before we kind of move on there? Like, does that kind of anchor that a little bit better? Do you think?
Yeah, it was a good wrap up. Yeah.
Okay, cool. So then going back to my second kind of core point is around the housing shortfall. And I'm not going to go back over all the kind of figures, but we're several 100,000 properties short of what we need right now, and that deficit gets bigger by about 56,000 properties a year. And in order to close that gap and to close that deficit, it would be the single largest civil engineering project in the history of humankind, potentially, and it would require someone who actually has a plan and a way to complete that plan. So currently, we don't even have a plan that would work to do that. We don't have the materials, we don't have the people, we don't have anything, and we don't have a plan. So how could we possibly close the gap that will take us decades to close if we don't have a plan that's going to work? It just doesn't make any sense. So just on those 2 things alone, we can see that things are different to where they were a decade ago, 5 years ago, 20 years ago, just those 2 things. So do you want me to kind of clarify any of those points before I move on to some of the other points?
No.
All right, cool. I'm going to go through the next points one by one so we get a chance to unpack them before I kind of move on to each next one. So the next point but just to be clear, those are the 2 main ideas. They're the 2 main ideas that if I want people to walk away with just 2 ideas, it's those 2 ideas. They're the 2 main things you need to know. Now there's some other things that we should discuss that support these ideas and will contribute to this overall supercycle thesis. Number 1 is liquidity and credit expansion. So I believe that we're at the start of a interest rate easing cycle or a monetary easing cycle. And it's likely that interest rates will stay lower for longer. And that is, again, tied to the idea of monetary debasement, tied to the idea that they need to increase monetary supply over the long term. Now, to put some numbers around this as well. So I believe that, and again, I could be wrong. So this is a belief. This is the other stuff I think is much more fact-oriented. This is an opinion. I believe that we're going to see a trending down of interest rates over the next 24 to 36 months. I don't know that it's necessarily going to be a sharp crash to the bottom. I think it's going to be a trending down over the next 24 to 36 months. I think we'll stabilize at around 2 to 3% interest rates, maybe lower. Maybe lower. It may even go down. If we need to continue to stimulate growth, it may even go down. We may even see it going back to 1% and stuff like that. Although that's not where I'm hanging my hat. I'm going to hang my hat somewhere around the 2% interest rate long term. Now, for every 0.25% interest rate cut decrease, so every 2.5% decrease in interest rates increases borrowing capacity by about 3 to 5%. Now, what does that mean? Well, that sounds good. Like my borrowing capacity goes up. What that actually means is that we have 3 to 5% more credit creation happening in the economy. And when credit creation actually creates the money supply in the most part. There are other ways that money gets created as well. But the main driver of monetary creation is credit creation. So if we have 3 to 5% more debt getting created in the economy, that's 3 to 5% more money getting effectively printed as well. And so that is going to increase liquidity in a market. That is also going to increase demand as more people have the functional capability to buy properties. That is going to drive prices up. And it's going to constantly be a game of like capability increases by interest rates going up, prices keep going up. Like this kind of continues to chase itself. So that is going to continue to drive things up as well. So I think that as a big thing is really going to, so that the increase in access to credit is going to increase demand. It's also going to accelerate monetary debasement, and that's going to fuel capital rotation into real estate. That's my next point. Thoughts on that, Gabby?
Yep. No thoughts. I agree. Like, I think it's it's important for people to think through it's thinking through that interest rates are likely to come down and the impact that will have and why. Because I think just looking at there's going to be increased demand is one way to look at it, but thinking through the impact on liquidity is not something that people give much attention to either. So I think it's important. Yeah.
Yeah, totally. So just to put that in context again, so if it's 3 to 5% increase in borrowing capacity for every 0.25% interest rate cut. So if you drop interest rates by 1%, so they're currently at, what are they now? Maybe 3.85. You know what? They're going to need to check actually. So I should know the cash rate. So I'm going to need to. I'm going to need to check that. But let's say it drops by 1%. Let's just say it drops by 1% from where it is now. That would be somewhere between a 12 to 20% increase in borrowing capacity across the board. That's a 12 to 20% increase in debt capability. So that's a 12 to 20% increase in money supply. So it doesn't require the government to sit there and churn out the money printer. It's just like credit creation can actually force up money supply and increase monetary debasement as well. So that's one point. And then the other point there is that it's another demand driver. So we've talked about the demand drivers from immigration and population, that demand is outstripping supply. But what about when you have people that are already in the country that suddenly have a greater ability to buy property? That actually creates a second layer of demand. So not only do you have more people than you have houses, you all of a sudden have people that couldn't buy properties who now can buy properties. So you've actually increased the buyer cohort of that same number of people. So then that can create a demand deficit that it then blows the 56,000 deficit out of the water again, because all of a sudden you have more of the people who are in the country already wanting to buy properties. So it's going to change that demand dynamic again, which is going to exacerbate and increase that. So the credit cycle, the way I believe that's going to play out, is going to change fundamentally, increasing monetary debasement and also increasing the demand side of the equation.
Got it.
Okay, great.
What's your next point?
So my next point is, I kind of touched on this as well, but Australia's, I've kind of wrote in my notes, Australia's enduring global appeal. So I kind of touched on this just a moment ago, so we don't need to kind of maybe labor over this point. But I think that as the world continues to change and as countries and economies grapple with a very rapidly changing world, we're going to see people migrating to places where they can feel safe and where there's prosperity and with all this kind of stuff. And I think that prosperity is going to become distributed differently around the world, just in the same way that real estate markets have their own different fluctuations. You know, when I talk about a kind of, this is actually going to be my next point, but market rotation is going to be my next point, which I'll dig into. But as we think about how demand moves around in the Australian property market, demand also moves around in the global, citizenship market. Basically, where do people want to live? And so what I think is going to happen is even as economies start to falter in the next, say, 5 to 10 years because of deflationary forces, and I think we're going to see a lot of issues. I think Australia is going to be able to hold its own because of its prosperity, its natural beauty, its rule of law, its good facilities, all this kind of stuff. So I think we're going to end up with a very high demand of people to come into the country, and I think that's going to prop up potential any kind of potential downside impact that may happen through loss of jobs, all of this kind of stuff. I think that's going to prop up demand long term. So I think that is going to be a structural driver that's actually going to support any deficit we may have through job loss or displacement or anything else that might happen through AI is going to be supported by a significant demand coming into the country. And I think that's a really important consideration. I think trying to get your head around that is really critical, because that it kind of underpins and kind of safeguards us from other exogenous shocks. And you really just need to look around the world and go, okay, where would people go if their country was failing? Where would they go? They're probably not going to go to the UK because that is a basket case at the moment. They're probably not going to go to the US because the US feels broadly unsafe. They might actually. So for a lot of people, the US is still a pretty desirable destination. They're probably not going to go to South America or Southeast Asia or Central Asia or Africa. They're going to seek out probably countries like maybe the US, maybe Australia as kind of safe haven countries. That not only brings in people, but also brings in capital. Because capital, as you mentioned earlier, capital flows to where it's safest. So capital is going to want to flow into Australia, and because it's going to be a safer market with more structural demand, that is going to drive net capital inflows. We already know that Australia is a net capital importer. We've covered that in previous episodes as well. So that is going to drive that as well. So we're going to see more demand and more capital inflows into the country. And the other piece here as well to think about the international demand and why that's important to understand is because Australia needs immigration. This is why you kind of made the point earlier, Gabby, that if we wanted to rectify the imbalance, we could taper off migration, right? Basically, so we could kind of find the equilibrium between the amount of people coming in and the amount of houses we could build, basically, right?
Yeah, I wasn't saying that's not my opinion. I was thinking through the equation of.
Yeah. Sorry, I didn't mean to frame that as your opinion, but no. But you made that point though that could be a thing, right? But the problem is Australia can't handle that because we have an aging population. If we didn't have more people coming into the country, what we would have is a demographic-driven deflationary bomb, which would explode on the country, which would be no good. And so, because we have an aging population, if we just stopped immigration coming in, we wouldn't have anything to support the economy. And so we have a GDP in Australia that's driven by immigration. And so I think that there's no feasible scenario, certainly in the next, I don't know, there's no feasible scenario in any near-term horizon where I can see that would stop international migration being a significant thing. So that in and of itself, and understanding that would be continued international demand is actually very important to understanding that kind of side of demand driver equation. Does that all make sense?
Yep.
Okay. You seem to have less questions today, Gabby. What's going on?
No, I'm just digesting it. I think everything you're saying makes sense, to be honest.
Okay. So yeah, okay, cool. Feel free to pick it apart if you think that I'm not explaining enough, or you want to dig into things a little bit more. I don't want to feel like I'm just like rabbiting at people. So
nah.
Okay, fine.
Yeah, good man. Oh, I should say
fine,
man.
fine.
Dude.
Thanks, bro. So let us know in the chat if this is all making sense to you guys. I've seen a few people firing some stuff in there. We'll just take a breather for a second. Let us know in the chat if this is making sense to you, if you agree or disagree. I'd love to hear from you because I feel like I'm just dumping a whole bunch. I've thought about this a lot, right? So I have a lot of stuff to kind of dump on the table, but I want to make sure that you guys are all understanding it and getting your heads around it. Charlie says it's freaking wild how AI is changing the agency space. Absolutely. It's changing everything. It's wild. Braden said on top of the definition of housing is changing. Everyone wants more and bigger, closer to main cities rather than just providing shelter. Absolutely, Braden. Actually, the dynamics of housing is changing a lot. So we actually used to have something like 2.6 or 2.8 people per house on average. Now it's down to, I think, 2.26. So that is actually pointing to more people want their own places, and they want those places to be big enough for more than just them. So that's changing the demand equation. So because if you said that broadly speaking, every house or every property in Australia had 3 people in it versus every house and property in Australia had 2 people in it, we'd obviously need 30% more houses in the latter scenario. So understanding those kind of housing dynamics is also very important to understanding the demand side as well. Matthew said, you spoke about it a few weeks ago, unrealized capital gains on super, a lot of news about this new scheme, on the thoughts and updates, possible effects on the property market. Matthew, I might park that because it's a bit of a different conversation, but I think, you know what, let me come back to it at another point when I have some like kind of more consolidated thoughts around it. I think it's a crazy scheme. That's the first thing. I think it's a crazy scheme. I don't see it like being a significant headwind to the property market or anything like that. I just think it's a crazy scheme. So, yeah, do not support that idea. Do I think that that Australia is decoupling from the global debt cycle on purpose? Now, that is a world-class question, Neutral Rockets. Do I think that Australia is decoupling from the global debt cycle on purpose? That's a really, really, really good question. I would say maybe. But I also think it could actually be accidental. And I think accidental is probably more likely. Let me explain why. So the reason that Australia would be decoupling from the global debt cycle is because the average bond maturity rate is so much higher than the rest of the world. So the average bond maturity rate in the US is going down, and it's like it was about the same as Australia, but I think it's down to roughly an average of 3 years in the US, and I think it's roughly an average of 5 years in Australia. I covered that a couple of episodes ago, so don't quote me on those numbers. But it is longer, right? It's noticeably longer. And I think that is probably, as much as anything, a reference to Australia's economic stability and perceived economic balance in the rest of the world. It's seen as a very safe place. We tend not to have recessions, all that kind of stuff. Like it's quite a strong economy. And so stronger economies mean you can have longer dated debt because people are going to believe in the economy for longer. So I actually think it's more likely to be accidental, and I think it's a byproduct. And I think if you just imagine any of those scenarios where you've seen, anyone's seen the kind of the science experiment where you get the chain of beads, you get them to swing all together, and then they go all out of sync, and then they sync up again, and then they go all out of sync again, and then they sync up again. I think it's more like that. I think it's more of just a kind of energetic physical frequency offset rather than some kind of mechanical, like we're gonna decouple ourselves. I think it's more likely to be that. I think it's more likely to be natural market forces, which is good. Braden says, I feel like the problem you're talking about relates to shelter rather than what's being built. I think that, Braden, I don't know that I necessarily agree with you. It relates to shelter rather than what's being built. I think I might need clarification on your question, because I don't know by definition what you mean by what's being built versus shelter. I think demand is spreading out across the country, and that'll kind of lead me into my next point, which is relative affordability drives market rotation. And I think that the housing dynamics matter a lot. I think that people aren't able to afford as bigger houses as they used to be generally. So I think that there's a tendency towards apartments versus houses overall. I think we can see that trend. Or there's a tendency towards people finding more affordable locations. And if people want bigger houses, they tend to go where they can afford those houses rather than trying to build trying to take a house from Ballarat and stick it in the middle of the city. I think people understand that won't work. But I think the dynamics of how many people per house really, really matters. And I don't think people think about it in terms of shelter. I don't know anyone who rents a house or buys a house and just thinks, well, it keeps the rain off. Like, you might hear people say that jokingly, but like, I don't think anyone's just purely thinking about this is shelter. People see their home as an expression of their identity. They see their home as an expression of their future self, the best version of themselves, where they are in their life. It's an identity factor. And so I think that it is much more than just shelter in Australia. So I'm not sure that I think it is a shelter issue as opposed to the fact that there is a significant amount of demand and a significant amount of supply. Full stop.
Yeah, I think maybe a piece of that. Yeah, I think maybe a piece of that was talking about the it used to be 2.8 per household versus 2.2 or whatever it is now. So that changing dynamic relatively impacts the demand level, right? The demand for buildings to be built, because more people are expecting to have a little more room than they once wanted as well. So that's affecting building approvals and building supply needed.
Yeah, makes sense.
Kind of where it comes in. Yeah.
Yeah. So, and Braden's just clarified his point. So he's talking about the example where I used a hotel versus houses. Yeah, absolutely. So building a hotel with 7,000 rooms in it is not the same as building 7,000 houses. or building whatever it is, 3,500 two-bedroom apartment. It's like it's very different. So 100%. So the example of using hotels is just an example to say these people built these rooms all tied together without all the facilities and faculties of a home, without the space, without all of these separate roofs, separate walls, separate all this kind of stuff. And it still took them over a decade to do it. So how are we going to go and build all these houses? So yeah. So the point is that building a hotel should be easier than building 7,000 hotel rooms to house 15,000 people should actually be a lot easier than building 7,000 houses to house 15,000 people. So there's that point. So let's move on to the next piece, because all of this, by the way, just to anchor this back to the core thesis of the episode, is are we moving into a property market super cycle? So I've outlined the kind of core drivers, but then there's some other things to think about. When we think about a super cycle, does that mean that all property prices go up everywhere? Does that mean that like we just go in this like exponential boom, everything in the country is going to go up like COVID, which was a boom? No, I don't think that. In fact, I think one of the hallmarks of this super cycle is going to be the fact that there is going to be there's going to be rotation between markets on a relative affordability basis. So what does that mean? So if we look at Sydney, I've got some numbers here actually. So the Sydney property market, actually, let me just quickly find the numbers that I've got here. The Sydney property market at the moment, on average, costs about 12.5 times the median income in the area. That's across Greater Sydney. In Bondi, it's 29 to 1. So it's 29 times the household income to buy a house. So, and that is pretty wild. Compare that to Perth, for example, at 6.2 times. Now, I'm not suggesting for a second anyone go buy in Perth. In fact, I think I don't think that's the right time. But the idea here is Sydney and places like that, where relative local affordability is so much higher than the income, actually means that those property markets don't have as far to run. So you can start to look around the country and you can see, where do I find opportunities where the suburbs and locations have an appropriate combination of jobs, lifestyle, and relative local affordability. And that is actually going to drive a rotation of capital between markets, because we have more people that are able to work from home. We have more people that have got remote flexibility. We've got more capital wanting to flow around and seek safe havens in real estate. And so what I think we'll actually find is that it'll be a rolling boom rather than like everything goes up all at once. But I think what we'll see in aggregate is the property prices will continue to be driven by these forces over medium term. I think also over long term, should I say. I think also what we're going to see is cycle shortening. So whilst you might see what we may have seen in the past is that a market might have an acceleration period and then a stagnation period of say 10, even 14 years, and then another acceleration period and then 10 to 14 years of stagnation. I think we're actually going to see those cycles shortening. So you may have an acceleration and then it could be 2 to 3 years before the next kind of upswing, because we're going to have this kind of capital rotation moving around the country, and it's going to be seeking those relative local affordability opportunities combined with jobs and lifestyle. So I think that is going to drive a rolling boom across the country. We're going to have different pockets continue to, it's going to be like popcorn popping all around the country. We're going to have more places going through these kind of like volatility spikes where they're kind of rising things up. So that is kind of my point of view on how I think relative affordability is going to drive a rolling boom across the country. And that's actually going to support the idea of this constant uptrend that we're going to see. What do you think about that, Gabby?
Is there anything to look for specifically? Because it's obviously we're thinking through the top of the funnel being like money coming into Australia, like liquidity coming in, and as well in the local economy as well. But thinking about that popcorn analogy, you're already saying jobs, lifestyle, and affordability. Is there anything specific within that to be able to determine like where things might pop first?
Yes, but without giving away some of our proprietary stuff. Like
as I was saying it, I'm like,
I mean,
educationally.
So, I'm not going to tell you guys the answer, but we did recently do an analysis of 38,500 different trading indicators to work out what financial market trading indicators we could apply to the Australian real estate market. And we found two. We found two, and they're very, very good. And incidentally, they were two that we were already using, basically. So, So I can't give away the secret sauce. What I will give away is this idea of jobs, lifestyle, and relative local affordability. So what you want to look for is you want to make sure there's plenty of economic opportunity, because people need a place to be able to derive an income. And again, that is going to become distorted by everything we're talking about AI. So you really need to take that into consideration.
Yeah.
You need to think, where is that going? So jobs, it has to be a place that people want to live. So a classic example that I use with this is Port Hedland in WA. So they go through boom and bust cycles in Port Hedland because they'll have a lot of jobs and a lot of people move there, and then property prices will go up to, rent will go up to like $1,000 a week or more. And then nobody actually wants to live there. So as soon as the jobs go, people go. Nobody actually wants to live there. So you need lifestyle drivers to support the desirability of a location long term. It can't just be jobs. So you have to have jobs and lifestyle. But then in real terms, it has to be local. It has to be affordable in relative local terms. So what does that mean? That means based on median incomes in that area, is it relatively affordable? Now, people will stretch, but the more people have to stretch, the more of a cap you put on the markets that you're in. So Bondi is arguably a great lifestyle destination. A lot of people want to live there, although it has changed a fair bit in recent years, but it is still considered a great lifestyle destination that people want to live in. And so people will stretch for lifestyle, which is an interesting concept in and of itself, because people will stretch for that lifestyle desirability because they want to feel good about where they live. But the degree to which people have to stretch is the degree to which you're going to cap the capability of the market to continue to grow. Because if, like Sydney, it's already 12 and a half times, where do you go from there? Because most debt to income ratios with most lenders are in roughly around 6 times. So if you've got two households, if you've got a 2-income household, you can get to 12 times, because the 12.5 times debt to 12.5 times house price to income ratio is based on a single income, median average income. So if you've got 2 of them, you can get to 12 times. Where do you go from there? Because you're not like, wages have to go up in order for that number to go up, and it's still only going to be 12 times. It's only going to go up as fast as wages go, and wages typically don't grow as fast as property prices. So where does that go? Like, how do you make that math? It doesn't. I'll give you the snapshot. It doesn't. So to the degree that people are going to be maxing out on their borrowing capacity is the degree to which maxing out on their total borrowing capability is the degree to which those markets can continue to grow. Other than that, they're going to trend higher, probably closer to wage growth. And so Charlie's just put some comments in there. Does this all lead to yield compression? And does residential become a growth game? So fundamentally, residential is a growth game already. You make several orders of magnitude more money in residential real estate through growth. The function of yield primarily. So typically when we think about a portfolio, we now think about it we've evolved our thinking on this a little bit at Dashdot. We think about portfolios being in 2 halves, basically. Very oversimplifying it. Basically, the first half of your portfolio is making sure you can accelerate your capital to build enough of a capital base so you can rotate that capital into higher income assets. Higher income assets may include, and Charlie, I happen to know you have some of these, may include unit blocks that are high yield, high income, and they become really good residual income streams. It could include a variety of different things, right? But higher yielding, higher cash flow assets. But in order for you to be able to do that, to be able to replace your income, you need to build up a capital base that is large enough that you can actually afford to buy enough value of higher income assets to be able to replace your income over time. So that's actually how you replace your income through property. Growth, then cash flow, in that order. Now, that being said, most people are going to be seeking growth. And so the function of yields in the growth phase of most people's portfolio, the function of yields is to manage your borrowing capability, because the yields and the rents on your properties are going to be able to support your ability to continue to borrow. That is going to then allow you to continue to get capitalize on growth. So I do think that it is a growth game for sure, as opposed to, for example, the US market, which is much more yield oriented. Australia is a growth game for sure. Doesn't mean you can't replace your income, just means you need to have a strategy to do so. And by the way, I don't think commercial is a good idea, because I think that there is too much risk in the entire concept of business for you to be able to pin your to be able to put your tent on like commercial. Like, what are you going to invest in? Maybe warehouse space, but even then you would have to ask yourself if things are going to change that are going to disrupt warehousing as well. So just to kind of bring that back around yield compression, do I think there's going to be yield compression? Some, but also, Charlie, you've got to understand as well, we have a tremendously high demand, and that demand is unable to buy properties, and it's also driving rents up. In fact, let me just check. I think I have some numbers here on rental changes. Yeah, so last I checked, national rents were up 9% year on year. I'd have to double check that that's still accurate, but rents are actually increasing at a significant rate. And we started actually predicting this around 3 or 4 years ago. We said that we believe that there's a structural trend that is going to drive rents higher for longer. And that's driven by the fact that across the country, as at May 2025, the rental vacancy rate is 1.1% nationally. That's only slightly up from the record low of 0.9% in late 2023. Now, when we very first started Dashdot, we thought anything below 3% was good. We were like, if it's less than 3% vacancy rate, that's good. And that's the kind of like common kind of understanding is less than 3% is good. But like the national average rental vacancy rate is just 1.1%. That used to be what we would consider to be an extreme rental crisis, which is in fact what's happening across the country. So I think we can reasonably expect that rental demand is going to continue to be elevated as well. And so I don't necessarily believe that this leads to overall yield compression. I think that yields will probably normalize in line with the growth. And I think we'll see some oscillation between these two ideas. When prices run up, you necessarily have some yield compression, but then rents catch up over the medium term. So I don't think it's going to be a systemic trend of yield compression over time. Although that being said, what is also true is that over time yields generally trend downwards. So I don't think that we're going to see a reversal of that and see that yields trend upwards. But I also don't think we're going to see a steep drop off of yields. I think it's going to continue basically as it is, because we are seeing significant rental pressure as well. So I hope that makes sense. Any thoughts on that, Gabby?
I was actually just thinking, so one of our team shared about a stat in Victoria losing 24,000 rental homes in 2024.
Yeah.
And so that's 3.6% of Victoria's entire rental stock. And so it's like, but rents only increased 2.5% in the year to April. And so this all also happens at a state level as well. So we have like national level, but then we also have local level. This can also happen through state-based level in terms of like structures and incentives for people to be landlords in those locations as well. So it's another level factoring into people may not necessarily historically, the last few years, I think things are shifting a little, but haven't wanted to be landlords because land tax and all of the extra things and roadblocks that go into at the state level. So that's also factoring in.
Yeah, 100% agree. I think though that like Victoria's a great example where there's a lot of regulatory bullshit basically, and it has become quite unappealing to be a property investor there. But actually, if you can look beyond that, then there can still be upside in those markets. You just need to be able to look at what is the adjusted upside with all of that stuff taken into consideration, and is there enough of a structural trend to be able to support it? And I think Victoria is one of those scenarios where that is true. It's a particularly depressed market, and if you take 24,000 rental properties out of the market, I mean if you think about every rental property being a competitor to every property investor, that takes 3 point whatever it was percent out of the market. That's 3.6% or 3.2 or whatever it is percent less competition overall. So that means that in general demand is going to be driven up, as long as that's supported by population as well.
Yeah. And it doesn't necessarily mean that homeowners will immediately buy that stock either, because maybe they can't afford it.
Yeah, exactly right.
Yeah.
Okay, so I'm almost done. I've got some like really other kind of small points, and then I'd love to kind of get you to kind of pick this apart and challenge any parts of this, and for us to kind of like wax lyrical around it. So have a little kind of think about that, because the other piece of this I think is really, really interesting is demographic tailwinds. So millennials are now entering into their prime buying years, but boomers are starting to kick the bucket, downsize, do all kinds of different stuff. And so what that is causing, that's causing an intergenerational wealth transfer. So a lot of the, everyone says like, oh, the boomers captured all the wealth, yada, yada, yada. And that's kind of maybe true. Like you get a lot of boomers, they've got millions of dollars in equity in their properties, but they're getting older now. They're getting older, like they're retiring or they've retired or they're moving into a stage of life where they no longer need the home. And so what they're doing is they're either transferring those, like they're either passing away and that's getting passed on as inheritance, or they're downsizing, they're giving their kids early inheritance. All of this kind of stuff is happening in real time. It's not theoretical stuff. It's real stuff that's playing out. And so what we're already seeing is an intergenerational wealth transfer. So all of the money that's locked up with the boomers is actually being distributed now to the millennial generation, first time home buyers, all that kind of stuff. And so that's taking locked up capital and that's pushing that back into the active participant stage of the market. And that's going to continue to happen over the next 10 or 20 years. You know, like, you know, we've got people that are between 55 and 85 years of age that are passing on their wealth to their children or to their grandchildren and pushing that wealth back down the family line so that can be then used for them to be able to try and get ahead, because everyone knows it's getting harder to get ahead. And so that wealth transfer is actually driving more and more demand. So because the way to think about this as well is you may have a boomer. I'm just using boomer as a very generic term for anyone that's older, right? But you've got people that are older that maybe have got their homes completely paid off, and maybe that home's worth $2 million. Okay, so they've got a $2 million that's a $2 million home or $1 million, pick your number, but let's just use $2 million home that's fully paid off with no debt. And then they go, you know what? I'm going to downsize. I'm going to sell the property. I'm going to keep 500 grand for myself, and I'm going to distribute 1.5 million to my family, my kids. They take that 1.5 million or even a million. Let's say they take half. They take $1 million and then they leverage that 9 to 1. You've turned that into $10 million worth of capital. So you've taken a $2 million house and you've turned it into $10 million of capital that flows around in the market. And that is what is happening. And so that is driving, again, more demand. That intergenerational wealth transfer where there's no leverage on a whole bunch of assets that get distributed to people who need to use leverage. Then through the credit creation, that expands the money supply, and through the actual capital balance, that actually increases demand. So this isn't just like, oh, cool, money's shifting from point A to point B. It's money shifting from point A to point B and then being amplified. So think about all of the wealth that is locked up with the older generation in retirement funds, in homes, and all this kind of stuff that is being passed on to other generations. Then imagine that gets leveraged 5 to 1 to 10 to 1. That is where the money's going, and that is driving more and more demand. I think that is a really, really underappreciated aspect of it.
I was going to say, I think it's actually much more, it's the bigger idea and a bigger problem maybe that people are really even thinking about. I was just trying to remember, we pulled this stat. I cannot remember which episode it was, and I cannot remember the exact numbers, but we were looking at the total amount of debt in like the total value of real estate in Australia, residential real estate in Australia, compared to the total amount of private debt. And the LVR, so the difference between those, like it was only like 30 or 40% or something. It was very small. So the balance is this amount of equity. And I think like for most people have, like, if you've recently bought a property, you might have like 60, 70, 80%.
Yeah.
And then the rest is in debt. But this big chunk, for this to be the majority, that's all this equity that's sitting in this older generation that's holding, that's going to be transferred through to the next generations over the next 10, 20 years. So I think it's a huge thing that will impact the market generally.
Yeah. Well, let me actually just bring up some numbers around that, Gabby, because it is a really, really, really good point. So the total value of residential real estate in Australia is 11.3 trillion, and the total outstanding mortgage debt is 2.4 trillion. So 2.4 divided by 11.3 is actually 21.2%. So now if you then took the balance of that, if you said 11.3 minus 2.4, 11.3 trillion being that's 8.9 trillion. And then let's just say you amplified that by 5 to 1. That's going to add another $44 trillion worth of demand.
Yep.
Right. That's based on an 80% LVR. Now that's not an exact calculation. That's just done, live here on air. But I think it's a really underappreciated aspect of what's happening here. And this is part of the.
Sorry.
I was just going to say this is a big part of it, is the demographic deflation boom, right? So we have an aging population that is changing the dynamics of our economy. But then also you've got this wealth transfer that's happening. And it's like, okay, that money is going to get taken and going to get leveraged. I mean, that stat that we just used, like 21% LVR, like mortgage debt is 2.4 trillion. Mortgage debt is 2.4 trillion, and the total value of the property market is 11.3 trillion. Is insane. That's insane. So then take all that capital, add leverage to it, and you quadruple. You take that from $11.3 trillion residential real estate market, and you turn that to a $44 trillion real estate market. Imagine if all the house prices in Australia went up 4x in the next 10, 20 years, in addition to the other structural forces that we've been talking about. So it's pretty wild. Okay. And so that's kind of my final point, right? So, and I'm going to recap on these, and I'd love for us to quickly pick them apart in the last couple of minutes. And by the way, as I'm doing this, guys, I'd love, if you're here live, I'd love for you to ask some questions, drop some questions in the chat, because I'd love to answer them. I'd love to dig into those as well. So the kind of final point is that we have had some kind of super cycles before, and there have been other, like, super cycles are not unknown phenomenon. It's not a thing that's never happened. And so I kind of touched on this at the start. We've had loads of different super cycles. There's been microchip super cycles, mobile phone super cycles, internet super cycles, commodity super cycles. So there's been historical precedent of different asset classes being hit by structurally changing forces that drive systemically long periods, sometimes decades long, sometimes 20, 30, 40, 50, 60, 70, 80 years long super cycles. So this isn't necessarily just a 3-year thing. And by the way, when I'm saying super cycle, I'm not talking about it's going straight up to the right. I said that at the start. I'm going to say it again. Yes, we are still going to have ups and downs, and it's still going to go in a bit of a kind of a wavy path. And broadly, you could say, well, isn't that what property does all the time? But I'm talking about a really structural underpinning here that basically means that property can't fail, right? So if you took failure off the table, if you said, okay, well, it's basically impossible for Australian residential real estate to fail, and that it's going to continue to grow, then you've basically reduced all of your tail risk. You've taken off the left curve, and you've basically made it almost risk-free. Now, I'm not saying that investing in real estate is risk-free, and this is not financial advice, and don't be silly, and all that kind of stuff. But the fact of the matter is, when you start to compound this stuff up, you go, holy shit! Like, this actually does point to the fact that there's going to be a systemically long trend. I'm going to quickly recap on these points, and then we can kind of pick them apart and kind of go from there. So, the two main drivers, in my opinion, are systematic monetary debasement, driven by the largest deflationary cycle in our species, which is broadly driven by AI, and also supported by a deflationary bust from demographics as well, from an aging population. Plus, we have an extreme housing supply demand imbalance. Extreme. To fix that would be the largest engineering project that I think that has ever existed on the planet. And to Braden's point, building that many houses is a lot different to building a hotel. And so to actually build that many dwellings or individual dwellings is actually a very, very, very significant feat. And we've got several 100,000 properties that we would need to build. In addition to those two core points, they're the two kind of pillars of the thesis: liquidity and credit expansion. So as interest rates lower, I believe they will lower over the next few years. That's going to increase access to credit. And the access to credit is going to increase the monetary supply, because we increase the monetary supply through credit creation. And that's going to increase demand for properties as more people have access to credit and the ability to get into the property market. Plus, Australia needs to continue importing its population because we have an aging population, and so we don't crash the GDP. We need to keep immigration high in order to be able to support the aging population demographic. So having an enduring global appeal for people to want to move to Australia is very, very good. And that ensures that we have long-term demand for both capital inflows into the country and also human being inflows into the country to support the demographic need in the country, to support capital inflows. Plus, relative affordability is going to drive market rotation around the country. So I'm not talking about a nationwide everything boom. I'm talking about a rolling boom, where it's going to be much more like a saucepan full or a frying pan full of popcorn, where we're going to have different locations popping off at different times. And we're going to see overall, it's going to kind of like overflow up. Now, the reason that relative local affordability is important is because debt to income ratios affect the ability for people to expand their buying power within any given market. And that's why when you get markets that are like Sydney, that are, say, 12.5 times debt to 12.5 times house price to income ratio, I think there's a limit to how much those markets can grow. I'm not saying there won't be price growth, but I'm saying there's going to be a structural limit to how much those prices can grow. Plus, we then have the intergenerational wealth transfer, where boomers and retirees and aging population are actually transferring their wealth to younger generations. Those younger generations are then going to amplify that capital with credit to go and buy properties, to try and find the dream home, to try and get a foot on the property ladder. That is going to increase demand significantly in the property market sector as well. And we have historical precedents of significant super cycles happening before in other markets as well. So there's precedent of this kind of thing happening before. So I think that's going to drive a very structural boom over the long term. And I think that if people can understand that, and they can start to ladder these things up together in their own mind, they'll start to see there's almost no way the property market could crash. And we talked about the 18.6-year cycle earlier in the episode. The 18.6-year cycle basically says that there's going to be a property market crash in like 2027 or something like that,
Mm.
where property prices will go down, like down. Like it's this big kind of like doomsday scenario where property prices are going to like fall through the floor. And I would just ask you to, I would ask not just you, Gabby, the royal you. I would ask anyone to explain to me how that would happen. Like how actually would property prices go down? I haven't had any, like, it's very easy to be like, but the cycle says that's going to happen. Well, okay, but explain to me what is going to cause prices to go down. I'll wait, because I haven't heard anyone come up with a good thesis yet, other than like the plan says so. And that's not a real, that's not a real thesis. That's not a real idea. So what do you think about this, Gabby? Do you think it's been useful, interesting?
Yes. What I want to wrap up with is just, so let's say I'm listening to this, I'm on board, like I've consumed the information. I believe, as you're saying, you don't need to believe, you just need to understand how the pieces work together. And hopefully it should be obvious that we are entering a structural super cycle in our market. What do I do with that? Now, I know that we've got a huge variety of people listening in a variety of situations, but if I'm just think through a normal, everyday Australian, what do I do with this information?
Well, I think it depends on your financial capability. That's the first thing.
Yeah.
If you are financially able to buy residential real estate in Australia, then you should get off your ass and do it. Now, let me qualify that a little bit. A, you need to make sure you're buying the right property in the right place at the right time. And if you start trying to build a property portfolio without having a plan, then you're absolutely missing the point.
Mhm.
So, not to kind of like shamelessly plug Dashdot, but if you actually want to build a successful property portfolio and actually have a plan and actually have a systematic way to do it that's driven by technology and data and the most advanced property market systems in the country, then book it a call to speak to Dashdot, because you'll get a plan, you get all that kind of stuff. So if you actually want to, because most people they make the mistake of going, okay, great, I believe in property, let me just go buy a house. And the statistics point to the fact that 71% of property investors never get past the first property. So you can stuff this up. So you can listen to this and go, oh, real estate's going to be good. But if you don't know where to buy, when to buy, and why, in line with your individual strategic portfolio needs, probably going to get stuck, or at least go a lot slower than you should. And in an environment where everything is speeding up, the last thing you want to do is slow down, because slowing down is as good as going backwards in an environment that is speeding up. So it's very, very, very important that you get this right. So I'd encourage you to take it seriously enough to want to get professionals who can really help you. Not just someone who's not a shopping service that they'll just go buy you a house, but real partners that will go on a real journey with you, that'll really care about your long-term position, and that's built technology to support that. So that's the first thing. The other piece I want to unpack with that is, a lot of people have the capability to buy properties, but they get in their own way. The largest cohort of property investors has got 0 properties. They get stuck in their own mind. They get stuck in a decision. They get stuck. But I'll wait till the next interest rate cut, or I'll wait till the point here is that's a rounding error. If you're waiting for like some like little thing to just be, that's a rounding error. What you want to do is you want to get in. You want to get in aggressively. You want to play hard. You want to play to win. You don't want to sit on your hands waiting for like, but let me just wait until this other random exogenous event happens and then I'll do the thing, because you're not serving yourself. You're missing out. So I'd encourage you to take action, get out of your own way, and participate, but do it in the right way. And obviously, my recommendation would be to work with Dashdot, because we've built an entire business to help people do this. And it's not just a property buying service. So that's the first thing. The second thing is, if you're not financially able to participate in real estate, then you still need to take action. That doesn't give you permission to go sit on your ass and do nothing. What you need to understand is the world is changing. The world is changing faster than you realize right now. I guarantee you. I guarantee that every single person that is listening to this doesn't really, really actually comprehend how fast the world is changing. And we are moving to, and we'll cover this in a future episode, we are moving to a post-labor society. And when capital no longer needs labor, you need to start asking yourself, how does labor get capital? The way you get capital is you become an owner. So you need to move off the consumption flywheel and onto the ownership flywheel. And they are two very different flywheels, by the way. The consumption flywheel is a flywheel that actually goes down. It's a downward flywheel. It's going to pull you down and kind of set you back. The ownership flywheel accelerates your capital, accelerates your returns, and amplifies your opportunities into the future. It's a flywheel up. And you want to participate in that. And if you don't get off your ass and start participating in that, then you are going to be left behind. There's a question here from Brad Jones. Is this the end of the middle class? There's another question from Braden here. Do I believe the super cycle could be the final tipping point between the two classes of buyers and renters? And at what scale do I think this could be in terms of population? And both of them point to the same idea. We are bifurcating as a society into two classes, owners and consumers. Owners, they own assets. They own hard assets like real estate. They own stocks, Bitcoin. They own stuff that actually has transferable value over time. It transports their economic energy through time and space. Consumers don't. Now, to be clear, I have no problem with renting. And in fact, we may rent forever. I have no ambition for us to be homeowners specifically. You can be a renter and you can still be an owner. Rent is, but renting alone, just renting and not actually participating and accelerating your capital in other markets, that is not a smart move. That is just the consumer class. So you have consumers and owners, and you need to move onto the owner side of the fence. Otherwise, you will get left behind. And yes, society is bifurcating into these two classes. The middle class is gone. There's going to be owners and consumers. And you need to decide on which side of the fence you want to be. Which side for you, which side for your family, which side for society. Where do you want to be? Because I know sure as hell that I want to be best positioned as I can for the future, for us, for everyone that I know, to be able to support them. And you don't get that way by sitting on your hands doing nothing. And so if this episode has given you one motivation, it's that the world is changing and you need to change with it. And you need to stop sitting on your hands. That's what I would say.
Yeah. Yeah. It's essentially why we're doing any of this, right? You and I are having these conversations every week. It's can see what's coming and what's changing in the world. And we really want to encourage as many people to take action because it's like, there's not too much that we have control in terms of like the macro state of the world, technology advancements and everything. It's like, this is what's happening. Here are the steps that you can take to actually make sure that you are on the right side. Do we agree with the two-class system? That's debatable.
No.
Not this kind of conversation. But
I mean, it's like yeah. Sorry to jump in there. Yeah, it's not about like whether we think it's a good idea or not. Like it's just it's looking at what is. Do I think water should be wet? I mean, I don't know. Like, should water be wet? I don't know. Maybe it should be dry. Who knows? But I can tell you it is wet. You know, like
it is wet.
You know,
yep.
Should fire be hot? I'm not sure. Like, but it is.
Sure. But it is.
So,
yeah. And us having these conversations, it's because like if you're here listening and you're part of this community, it's hopefully you can see this and hopefully we're doing a good job in helping you to take action as well, like covering the high level ideas and helping to educate you to be able to see what we can see and then also coupling that with action so you can take steps forward. But it's also hopefully helping you to frame this up for people in your world who may not see this, because I know you and I, Goose, we still have people in our worlds that just can't wrap their heads around what's happening, or they don't see the changes and how rapidly they're happening, and they don't understand money and the impact that this is having on all of our wealth situations and our futures. And hopefully the kind of content that we're putting together with this podcast is helping you guys to be able to have those conversations with people around you as well, to try and get as many people to take action, because it's happening. Like you said, Goose, it is happening. So it's our duty to help those people that we care about as much as possible to move them on that path as well, so they don't get left behind.
Yeah. The train is leaving the station and like you don't get to move the train back. Like it's going, you get to get on or you get to stay on the platform. It's pretty simple. Yeah. Like it's pretty simple.
Yeah.
So there's a question in here by Neutral Rockets that I just want to get to before we wrap things up. So Neutral Rockets has asked, are these local booms that I'm talking about driven by investors seeking to put capital somewhere? Yes and no, Neutral Rockets. So you got to remember that real estate investors only make up about 33% of the market. So that 33% of the market means that house prices are almost going to always be driven by genuine home ownership demand. That is where most of the demand comes from. Real estate investors actually make up a portion of the market that seeks to rent. So it's a natural part of the market equilibrium that real estate investors only fulfill a portion of it. And really that 33% very rarely changes. It may oscillate a couple of nominal percentage points here and there, but it stays about the same. So whilst, yes, real estate investors that are more borderless investing focused are going to drive capital flows into other parts of the country. And yes, that has had an influence already, absolutely, versus where it was several years ago. What I would also say is it's also going to be driven by the other factors being changing in working dynamics, the ability for people to work remotely, the changes in economic opportunities being pushed back out to decentralized locations because there was a big centralization movement in the 2000s and the 90s, and that changed. So, I think it's going to be driven by genuine demand moving around those areas, plus definitely capital flows as well. And I think people are going to be seeking out ways that they can find that optimal balance of jobs, lifestyle, and relative local affordability. And that's going to drive those booms in different places. And that's going to be driven by people who want to live in different places, not just people who want to invest. So,
yep.
Cool.
Awesome. So, guys, again, thank you for joining us live. It's been a really cool discussion. Again, I really care about getting this message out to people because I think we can help a lot of people if we just start with education and then frame it towards action. So if you do know people that will get a lot of value from this episode, please hit share. If you're on YouTube, there's just a little share button, or you can share wherever you're listening to this on the podcast as well. Share it with someone that you care about to help them to learn about everything that's changing in the world so that they can hopefully take action too. If you are not subscribed already, please subscribe to the show as well as hit the like button on YouTube if you are there. Goose, I'm actually going to jump the gun and just say I think next week we should do the AI episode. So if you
better get ready.
If you are here and you are interested in exploring more of that topic next week, we'll be back the same time next Friday and we'll cover Goose's well-prepared topic.
Well, I have a lot of thoughts on it. I just need to consolidate those thoughts into some kind of like actionable
You're on the hook
points.
now, so
yeah, it's fine. Yeah,
awesome.
Nothing drives accountability like a deadline, so that's fine.
Beautiful. Public. Done now. Cool. Thanks so much. We'll see you next week.
Awesome. Thanks, guys. See you next week. Bye.